And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Monday as we get ready to start another week of July and getting ready really for this week. It is all about the mega cap earnings right this week and next week. In particular, Google, the likes reporting this week and next week. So we're going to have a lot of stuff. Big cap, big tech earnings are going to be driving the markets over the next week. And again, kind of, so far, we've only got about 12% of companies have reported so far, so it's still very early to say how things are going to work out, but so far so good. About 83% of companies are beating estimates as expected because estimates have been lowered so much going into this particular quarter. We're now starting to see analysts starting to ratchet up forward expectations for the rest of 25 and 26. So they had gotten, because of tariffs, they had knocked down earnings estimates. Now they're starting to get a little bit cocky here and going, oh, well, I guess tariffs aren't that big of a deal. And now they're starting to ratchet those back up. So again, we're starting to see bullish estimates really kind of return to the markets here. But when you start looking at the actual underlying earnings data, it's fine, right? I mean, companies are beating estimates. Verizon this morning just beating estimates. That stock's going to be up about 4.5% this morning. Full disclosure, we own that position in one of our models. But that's been the nature of this earnings season so far. But again, what's really going to drive the markets over the next 2 weeks is going to be big cap earnings. It's going to be Google, Microsoft, Apple, Amazon. We're going to be scrutinizing those earnings very, very closely. Yeah, they're going to beat, but the real question is going to be AI data expenditures, what the forecast for revenues look like, particularly from their AI ventures, AWS for Amazon, importantly as well. That's their whole kind of data center business. So again, that's going to be the big driver of the markets over the next week. Again, not surprising, it's kind of the way it's always been, but particularly since big cap earnings have been kind of driving the markets and early expectations of it, big cap stocks as well, have been driving a lot of this market recovery since the kind of Liberation Day lows, particularly companies like NVIDIA. That's going to be a big focus. Now, NVIDIA doesn't report until next month, so they're very late into the earnings cycle. So we'll get Microsoft, Amazon, Google. We'll get most of the big, kind of the Mag 7 over the next 2 weeks. But again, once we start looking out, it'll be NVIDIA much later next month, towards the end of next month, that we'll get that report, and that'll be kind of the big one for semiconductors in particular. Outside of that, over the weekend, really not a lot happening economically speaking. We talked about CPI, PPI last week. Again, economic data still seems to be okay here. Now, it's weakening. As we've talked about before, there's clear signs that the economy is slowing down. We are starting to see some disinflationary pressures through the economy in different areas. But again, nothing dramatic here. And so this has kind of been an environment that's supporting kind of supportive of the markets in a way, because again, the concerns that, of recession and those type of things that we had earlier in the year have now all faded. One of the big drivers, it's kind of an interesting fact, that one of the drivers that's helping some big cap international companies is the weakness of the dollar as of late. And the dollar has weakened a bit. And again, as we've kind of talked about this before, that is basically the dollar trading against other currencies. So as the dollar weakens here, right, makes things more expensive. So if you're traveling, like when I went to the UK, I traded in a $50 bill, I got 26 pounds in return. So, definitely feel inflation when you travel overseas, but that's also a boon for U.S. citizens, U.S. companies that have international exposure, because the weaker dollar makes things cheaper for international individuals to buy them, so exports improve, and we're seeing that impact some of these. And again, when we start looking at the big cap earnings this week, particularly have a lot of international exposure, they should get a bit of help from the weaker dollar. And again, we've seen the dollar weaken here. It's actually been starting to strengthen up here a bit, kind of trying to form a base. We'll see what happens. We're back on a short-term buy signal. But again, that's been a help to some of these multinational companies because of the export benefit they get from a weaker dollar. Well, here, let's talk a little bit about what you need about to know before the bell this morning. I'll spit that out here in a second. Futures are, again, kind of pointing up mildly this morning. We'll kind of see how the market holds together today. Markets are overbought. We are still very extended above moving averages. And again, that's not, out of the ordinary. It's not a crisis situation type thing. But we are very extended on both momentum basis. Relative strength improved on Friday, had that rally that gave up some of its gains. We kind of broke out to new all-time highs on Thursday and Friday, pulled that back a little bit on Friday. So we're still flirting with all-time highs right now. But again, the deviation here, as we've talked about before, is important to pay attention to because moving averages are a little bit like gravity. And the further that prices get away from it, there's kind of that gravitational force that wants to pull it back down to earth, so to speak. And so when you get these kind of big gaps that you have right now, and again, we're about 6% above the 200-day moving average, that provides that potential area where you kind of get an air pocket that kind of pulls stocks back to earth. Now, there's support for stocks right now because of earnings. Now, once we start getting through really this week, next week, you're going to kind of get into a return of focus back to the economic data, and that's where you're most susceptible once we get into August and September. So July will be okay, most likely for the markets, but once we get through the month of July, really get into August, September, we're going to really have to start focusing back on the economic data, which, as I said before, is not great. It's not terrible, but it's not fantastic. So again, that kind of opens up the most likely probability that we get some type of a corrective action here in August, September. And again, a pullback to the 200-day moving average, at least, if not the 200-day moving average, which, again, there's a fairly big gap there. But even a pullback to the 50-day moving average would get you back down to about 60-10 on the index. So, about a 3% correction. It's not the end of the world, but a 3 to 5% correction, investors should kind of expect that sometime this year. They'll kind of reset some of these overbought conditions, reverse some of that momentum. Breadth has not been exceptionally strong here during this rally either. So again, there's a few of these catalysts that are sitting there that suggest you get some type of corrective action. We talked about this last week, raise some, kind of, and I wrote about this in the newsletter, by the way. If you go to our website, realinvestmentadvice.com, download this week's Bull Bear Report. I've got a whole long list of kind of tactical ideas for your portfolio, just kind of actions to take. But again, it's the basic rules right here of just taking profits, rebalancing risk, looking for a bit of a correction that you can then allocate some cash back to markets. But again, overall, the market's in good position. Nothing really going wrong here, just a little bit overdone. And again, today's article on the website, and by the way, you can get our articles at our website, realinvestmentadvice.com, of course. But if you subscribe to at Lance Roberts on Substack, they get emailed to you as well. So just come right to your inbox. Today's article, and we'll go through this a little bit in a few minutes, just talking about retail speculation. We're starting to see some of the same signs that we saw back in 2020 and 2021, which also kind of feeds into this narrative that you're getting a little bit overdone here in the short term in the markets. So some type of corrective action should be expected. Outside of that, again, volatility remains exceptionally low here. We're trading around 16, 17 on the VIX. Again, that's not historically low, right? I mean, we've been lower on the VIX before, but volatility is very compressed here. There's a huge sign of just complacency in markets, and again, that's kind of another caveat. Again, just you're kind of getting a position where we also get into the seasonally strong period for volatility, which is August, September. And that, so if you get a rise here in the VIX, that's also going to correlate to a correction in the markets as well. So again, just nothing dramatic here. Just pay attention to your portfolio at the moment. Again, nothing going wrong here. Earnings are going to drive markets this week. We'll see how that turns out. We'll keep you updated. But that's what you need to know before the bell this morning. We'll come back, talk a little bit about retail speculation back to levels we've seen in a while. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security, and how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Hope you had a good weekend, and we're back to work. Brent, my monitor's not working. So my wife is, my son's at college right now. My younger son out of the two, he's at A&M at the moment, and he's getting ready to finishing up summer school. And so he, my wife's all excited. He's going to come home on the 5th of August for about 2 weeks before the next session starts. And so she was redoing his room because the bed that he had in his room is the bed that he's grown up with. We've hauled this bed from house to house to house for like the last, 15 years. And so, so he's coming home. She goes, well, it's probably time to get him a new bed. So she bought him a new bed. Anyway, so it shows up in a box. Of course, it comes from Amazon, right?
Of course.
Right. So
Yeah.
comes in that. So it's laying on the front porch. It's raining outside this weekend, sitting on the front porch. My wife goes, can you go get that box? And I'm like, sure, I can go pick it up. And so I go outside, and this thing's heavy. It probably weighs a good 220 pounds, 230 pounds, something like that.
Oh, man.
And she's like, do you need some help? And I'm like, my wife is one of these people, she points well, but does not let help. I was like, no, I can pick it up. So
Mattress outweighs her by 100 pounds.
Right. Well, this is just the frame.
Yeah,
The
yeah.
mattress hadn't even come yet. So anyway, I pick it up, throw it on my shoulder, crawl, walk it upstairs, put it into the room. And I walked back downstairs and I said, you keep doing this to me. I'm going to go to a Coldplay concert. So now, if you don't know the story about an astronomer and the Coldplay concert, well, just go look it up on TikTok. It's there. It's all you need to know. But this is the new thread in my house.
It's meme comedy gold.
It is absolutely meme comedy. And trust me, I'm using this one. I may just buy some Coldplay concert tickets and just lay them on the counter just as an idle threat. Anyway, I do hope y'all had a good weekend. Glad y'all are back this morning. As you just heard on the commercial a minute ago, make sure that you have our YouTube channel, you're subscribed to it so that you get notification when we go live every day. We're going to be doing a whole lot of new stuff with the new podcast coming up starting in August. We've got some live interviews we're going to be having, kind of a different format as well. We're also streaming live this morning to TikTok. So we are now streaming live all at the same time to YouTube as well as X and TikTok, and we've got some other platforms that we're working on as well. So we are multi-streaming live on various platforms, so you can find us everywhere and easy, right there on your phone. So it's all there for you. Podcasts also, Apple Podcasts, all those. So whatever your favorite, Spotify, whatever your favorite podcast channel is, have that there for you as well. So easy to find. Be sure and like and subscribe to the channel. Appreciate it very much. So a couple of things. As I was noting, we are at this moment in the midst of earnings season, and there's nothing wrong with earnings and what's going on right now. But the exuberance of the market is getting just I want to say just a tad out of hand, but it is certainly starting to get a bit more noticeable kind of what's happening. And again, I want to show you this chart. So I have an article written this morning. It's on the website. It's called Retail Speculation. And this is 0-day options volume, which now this is the level of options volume on options that expire in less than 24 hours. So these are options right on the verge of expiration. They have less than 24 hours to expiration. And this is a binary bet. And what I mean by that is that this is money being invested that will either win or go to zero. There's really not much in between. You're either going to make money on this trade or you're going to lose all of it because the option is going to expire. And if it's not in the money, it expires at zero, right? You lose all your money. So this is a very binary. And if you look at the market in terms of speculation, this volume has just, and you can kind of look at the chart. I mean, this wasn't a thing that really existed back in 2011, 2012, 2013. It was fairly small in volume. Really starting in 2020, we saw this acceleration of this kind of speculative volume in these options, and it's just been continuing to grow. It's really picked up over the last 3-4 quarters as well, which is interesting because if you look at the chart, you see this big spike right there in 2021, 2022, and that was all of that stimulus money that was coming into households. Nobody had to, pay for any bills or rent, whatever. And so everybody was speculating in the markets. And you saw that kind of big jump in the volume. That volume just continues to increase. And again, this is really kind of the height of speculation. Okay, Brent. And the reason is that's not hedging. That's just a pure bet for the most part. I mean, this is just people betting that within 24 hours, Amazon, Nvidia, whatever stock it is going to move higher for whatever reason. So, people, just an example, Verizon was going to announce earnings this morning. So people go buy 0-day options on Verizon. It's a bet that they're going to beat estimates. And so if you did, you'll make money today because the stock's going to be up about 4.5%, right? Because they crushed earnings. Not surprising with the bar so low. But this is just, again, we haven't seen this type of speculative activity really so much, really kind of coming back in vogue right now to a large degree that we haven't seen since really kind of the post-pandemic type environment. There's when you take a look at like day trading stats and those type of things, a lot of day trading has really picked up a lot of volume. And we're seeing retail investors really starting to take on more exceptional risk. And if you take a look at, for example, margin is a good example of this, margin balances. Margin balances are back to all-time highs. I was writing about margin balances in 2020 and 2021 going into the pandemic. Coming out of the pandemic, we just had this massive surge heading right up into the pandemic. People were just, in 2019, just, really taking on a lot of margin debt. And so after that 21, 22 rally in the markets where they just kind of really just exceptionally took on a lot of margin debt, it corrected, obviously, in 2022. We had a big reduction. Then that's what you would expect during a market downturn. But since that October 2022 bottom, negative free cash balances, which is the measure of how much margin people are taking on, has surged to levels we have never seen before historically. Now, again, margin is a two-pronged thing. it is supportive of bull market. So as people take on more margin, in and of itself, margin is not a bad thing, right? So when you look at that chart, you go, oh my gosh, look at how much margin there is. The markets are going to blow up for sure. But margin is what supports the bull market because it adds additional buying power to the markets. However, it also works in reverse. It's kind of like I've written about this before. It's like the ingredients for dynamite, right? You can just put a lot of ingredients together and you can make dynamite, but it's inert until you add a catalyst of some sort, right? So you light the fuse and then you've got a problem. It's the same thing with margin debt. Margin debt's inert as long as markets are rising, but when markets start to correct, and they correct to a point that forces margin calls, then that's where it really becomes a problem. So all margin debt tells you is there's a lot of bullish speculation in the market. It's what's been supportive of the rise in the markets, and that will continue to exist until markets reverse to the point that it requires the covering of margin calls. That's the downside risk. But here's a different way to look at margin debt as well, which is margin debt as a percentage of disposable personal incomes. Now, the reason you look at it this way is if I'm investing in the markets, I have to have cash to invest. So if I've got $10,000 of cash sitting in a money market account and I want to invest, I can invest that into the markets. But if I run out of disposable personal income, right, I've invested all my cash, and I now want to buy more stuff, I have to do what? I've got to borrow some money. So I'll go on margin to do that. And the last time that we've seen margin debt to disposable personal income at this levels was at the peak of the market in 2022. So again, now this isn't a warning sign that the markets are about to crash and that we're about to have the come to Jesus moment in the markets. But this is all the fuel for a correction of some sort. Doesn't mean it happens this year. Doesn't mean it happens next year. These things can go on for a very long period of time. Here's a chart of the S&P 500 versus volatility. Volatility is not at historic lows, but it's at multi-year lows, showing a lot of complacency in the markets, which is certainly something that is also a catalyst for a correction. And if you take a look at smart money versus dumb money, now smart money is considered institutional money because they're the ones that generally control the trading of the markets. And then retail investors are considered the dumb money. But normally when you get big spreads between smart and dumb money like you have right now, that typically tends to be close to corrections in markets as well. This article's on the website. It's also on Substack at Lance Roberts. It's also on Twitter at Lance Roberts. So, wherever you find me, you'll find a link to this article. But again, this article just goes through a lot of the environment that we have right now that is very similar to what we saw during 21 and 2022 without all the stimulus and higher interest rates and no QE. It's quite fascinating, the environment that we're in now and how much money is coming into the markets despite the lack of the underlying supports that traditionally have supported much stronger bull markets. All right, be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security, and how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSE TV starting August the 4th will be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If Lance dressed up like Danny, maybe his wife would listen to him. No, that is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
The Real Investment Show podcast.
I had this conversation with my wife yesterday. I told her no on something she wanted to do, and she goes, "I'm sorry, I think I misunderstood what you said."
Same show, your schedule.
You meant, yes, you can do that, right? And I was like, "Yes, honey, that's what I meant." So, yeah, she goes, "I'm going to do what I want to do." I'm like, "Okay."
All right, love you. See you.
Exactly.
At realinvestmentadvice.com.
I could wear a tuxedo, and she is not going to listen to what I have to say.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So lots of talk in the chat right now about the Late Show with Colbert, which was canceled. And, lots of angst over it because, people are blaming Trump for the reason Paramount was losing $40 million a year on this show. They've been running this show for like 10 years. And they've been losing $40 million a year. And Paramount is trying to clean up its balance sheet right now because they want to sell it. And again, one of their big their big anchors, so to speak, is Taylor Sheridan, who they roughly pay $500 million a year to write shows like Landman, Lioness, the ongoing Yellowstone narratives, 1923. They've got a new one coming out soon. So he's been the cash cow for Paramount. So Paramount's trying to clean this up for a sale, merger, acquisition of some sort. So in order to do that, you've got to get rid of your bleed, and the Late Show has been a very big bleed. They basically pay Colbert about $15 to $20 million a year, and he loses 40. So it just made sense, right, at some point. But lots of angst right now. This particularly falls on the heel of, kind of the government pulling funding from NPR and the BBC as well. So again, it's just kind of it's got this political intrigue into it, but really this is a financial decision that was really about cleaning up Paramount's balance sheet. So again, do pay attention to what's going on with Paramount. I do have a feeling they're going to either merge or get sold here pretty soon. It'll be interesting to see who actually winds up picking them up. But, so again, just kind of going back to the markets, there's not a tremendous concern today of a correction in the markets. Again, if we're in the middle of earnings season, we've got a very high beat rate of earnings. Consolidated equity positioning is not exuberant. So there's room for this market to continue to kind of pull itself higher. And there's lots of bullish bias right now. So again, markets right now want to move higher. And there's certainly some risk coming up. August the 1st, we've got the reinstatement of the tariffs if a deal isn't reached. The White House over the weekend saying that the EU has gotten more engaged in wanting to strike a deal, so there's hope that a deal will get cut with the EU before August the 1st. But on August the 1st, all those tariffs come back if deals aren't done with the major trading partners, and then the administration has sent out letters to kind of all the other countries saying your rate is going to be 10%, right? It's a flat rate. But that's certainly a concern. If those tariffs come roaring back to where they were, if that deadline doesn't get extended, right? That's a potential risk that could roil the markets. Now, I don't think that's the case. Markets are going to look through this saying, yeah, tariffs are, he's still using stick and carrot. They're still going to get deals done, blah, blah, blah. So, I'm not sure tariffs are the risk. Generally, the markets, as we've talked about before many times, anything that you think about, right, that trigger for a correction, if you can think about it, the markets already knows about it. And, tariffs are well-known, kind of a well-known commodity now. We've been dealing with it for 3, 4, 5 months now. We kind of know what they are. We know what the impact are. We know what the administration's stance is and how they kind of trade off those narratives in terms of, as we've said, the stick and the carrot type mentality of negotiations. So tariffs probably aren't the issue that caused some type of pullback in the market. Earnings are going to be okay because, again, probably by the time that we get through this quarter, we'll see, somewhere between a 6 and 8% increase in earnings. Again, we've got a very high beat rate right now. So it'll be something that occurs that kind of takes the market off guard, whatever it is. And that gets you that 3 to 5% correction. But what you need for that correction to really have some teeth is a lot of exuberance in the markets and get a lot of people off sides. And bull markets are really great about getting people off sides. People take on too much risk. They take on a lot of speculative positioning. And that's what, a lot of options trading, et cetera. That's what gives the fuel for a correction when it occurs. Because you need that, you need that panic to get the correction kind of going. And so there's certainly the fuel there for this. And again, as we've talked about before, corrections are always a function of the fuel and the catalyst. But what you need is some type of ignition system to get sellers to come to markets. And right now we just don't have that. And earnings aren't going to be it. There was a lot of angst coming into earnings season about, my gosh, earnings. Now certainly there's some risk to earnings. I don't expect this to happen, but if Google came out and said, hey, you know what? We changed our mind about AI. It's not a thing. That would certainly cause a problem for markets, right? That's not going to happen. Meta, Amazon, Microsoft, kind of your big players, any of them that say anything negative about AI could certainly, and particularly in this case, CapEx spending. If Microsoft came out and said, yeah, we're going to cut CapEx spending on AI data centers by half, that's going to be a problem for Microsoft stock, right? And the markets, right? Everything tied to the AI trade would have a very big correction at that point on the assumption that everybody's going to cut data center spending. That's probably not the case. I'm not saying that's the case, but what I'm laying out is some type of unexpected announcement that could really kind of roil the markets. And that's what you just got to be aware of, is that risk does exist. And we have plenty of fuel right now between margin debt and, 0-day option trading and just offside positioning by retail investors. You've got all of the ingredients there for some type of corrective action in the markets. What you need is some spark to get that corrective action moving. And we just don't have that at the moment. And again, something will show up. Don't know what it's going to be. We never do. But these things occur. Remember, everybody's sitting around, fat and happy on AI, and then we have the DeepSeek announcement out of the blue, right? The market sold off. That's what I'm talking about. Some kind of unexpected event that occurs that gets all of a sudden everybody that was buying stops buying and sellers come back into the market going, okay, I'm going to sell here, right? It just, that's the way these things work out. And it always happens. And it always happens when we least expect them to happen. That's why complacency is very risky when you have a very high level of complacency like we have now. So again, as we've kind of talked about before, and again, if you go to this weekend's newsletter, the Bull Bear Report on the website, it's on X, it's on Substack. I've got a whole long list of tactical kind of positioning ideas for your portfolio, just things you can kind of think about in terms of, reducing risk, rebalancing portfolios, et cetera. It's all there for you. So anyway, that's just kind of the thing to think about here. Again, I don't know what the event is going to be, what's going to cause it. It's just there's becoming more and more signs of kind of this exuberance in the market that should be at least paid attention to. And most importantly, like I said, these things can last a while. So what I'm talking about right now doesn't mean I'm saying there's going to be a correction tomorrow. I'm not saying that at all. I'm not, and in particular, I'm not saying the markets are going to crash by 50%. I'm not saying that. I'm saying we're going to get a 3 to 5% correction, but it could be a couple of months before that happens. We saw a very similar environment in 2021. The market just kind of went up month after month after month after month, and we had some little 3 and 5% corrections along the way, but those were fairly rare over the course of the year. The market just kind of gravitated higher all year long. And that could be this environment that we just had because of two reasons. One, we just had a near 20% correction this year. So we've already forgotten about that, right? Everybody's forgotten about that 20% correction that had everybody calling me up, panicking, wanting to get out of the market. You just had that. You had a minor correction earlier this year and kind of in January, February. And you'll probably get another 3 or 5% correction sometime between now and the end of the year. That's completely normal for any given market year. The 20% correction was a bit abnormal. That only happens about 20% of the time historically. So that was a little bit abnormal. But 3 and 5% corrections happen, once, twice a year at least. So again, just kind of expect that and be aware of kind of how you're going to navigate your portfolio. If you don't mind that, and again, there's a lot of investors that don't mind 3 and 5% corrections. This is part of the game. Fine, right? You can just write it out if you want. Me, I'm not like that. Kind of like to use, raise some capital so I can buy stuff a little bit cheaper that I want to own. And so just last week, we trimmed back our positions in GE Vernova and NVIDIA and Palantir, which have had huge runs. Trim those back a little bit. If we get a little bit of a correction through earnings here, Palantir is going to announce earnings, I think, this week. If we get a bit of a correction in their stock price because they come in line with estimates and maybe disappoint earnings, it can happen. The stock pulls back, 5-10% on an announcement. We'll buy more shares, right? We like the long-term projection of where Palantir is going. But I like that opportunity to have some cash available to invest in the stock. And all we did was just take some profits. We just reduced the position back to its target weight in the portfolio. That's all we did, right? Nothing major. But that's just how I like to manage. But some people don't mind the pullbacks, right? They just like, whatever, just let it ride. That's okay too. What I worry about is when that 3 or 5% correction turns into a 20 or 25% correction. That's the part I kind of want to avoid, but that's just the way we manage money. But again, everybody does it differently, and so whatever works for you is fine. I just think risk management tends to work out better over time. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, interesting, over the weekend, there was a shocking announcement by Morgan Stanley that it'll take $1 trillion in debt to fund AI. And this is a really great point. Here's a chart of the large CapEx expenditures planned by companies going into 2025 and 2026. And you see this massive kind of surge. This is basically, Google, Meta, Amazon, Microsoft, what they'll be spending on data center factories, right? And this is going to require more debt issuance. Not necessarily government debt issuance, although I do think at some point there will be some government debt issuance for this. But corporations will be taking on more debt for this. But this is a really important point. This is the reason I bring this up is this is a super important point about debt and the usage of debt. I've had a couple of articles coming out over the next 2 Fridays talking basically deep dive into economics and, why Keynesian economic theory continues to fail. But the important takeaway is that a lot of conversation about the level of government debt at 36 trillion and it's going to go to 50 trillion and this is a terrible thing. And that's not necessarily a true story, true fact. Debt's important. It's the usage of debt that is the most important. Let me just frame this for you just a little bit, and we'll come back to this AI story here in just a second. A lot of talk about right now about how we need to have fiscal austerity in the U.S., right? We've got to stop spending money. We've got to start, getting back to a balanced budget, and we've got to cut down the level of debt that we're issuing. We can't. Debts and deficits are now a feature of the U.S. economy. And without debts and deficits, you're going to have a depression. A vast majority of growth, of economic growth, since the turn of the century, and really just prior to the turn of the century as well, has come from debt issuance. And because the government's debt is the household's asset. And what I mean by that is simply this, is that when the government issues debt, that money just doesn't evaporate and go into thin air. It goes somewhere, right? So I'm issuing debt. I'm borrowing money. Where does the money go? goes back into the U.S. economy. How does it go back into the U.S. economy, Lance? Well, Social Security, Medicare, Medicaid payments, defense spending, military benefits, Department of Education, Department of this. It's paying for salaries, it's paying for assets, it's paying for support. All that's winding up on household balance sheets at some point, right? Social Security, Medicare, Medicaid, all winds up on the household balance sheet. Now, where does that money go? Well, it goes back into the economy. Why? Because, well, people on Medicare are using it to pay for health care, right? Which is supporting the healthcare industry, which is paying for salaries, which is giving people in those industries money to spend within the economy to pay for their housing, their food, their shelters, those type of things. So the money winds up into the economy through the issuance of debt. That creates economic growth. So without that support, we would have negative economic growth. And that really tells you a lot about the state of the economy overall, is that the U.S. economy is just awesome. It's awesome because of all the debt that we've been issuing to help support the economy. It's a leveraged economy. And the same thing occurs on the corporate balance sheet as well. We've got a lot of corporate debt out there that's been financed at much lower rates. And that's been one thing saving a lot of major corporations. But this is a big problem with small cap companies. The reason that small cap continues to lag, and there's been a lot of expectation that, well, just any moment now, small cap's going to catch up to the rest of the world, and there's this huge undervaluation of small caps. Be careful of that. 40% of the small cap index is unprofitable. And they've got a lot of debt that they have to service. So if rates on that debt re-rate higher, they got problems. So the point about debt is, yes, debt is deflationary in terms of how we use it in the economy, right? We're funding people's spending, right? That's non-productive debt. Non-productive debt is disinflationary in the economy, because you have to service the debt. And when the revenues come in, almost 100% of the actually more than 100% of the revenue that we collect from taxes for the government is spent just to service the mandatory spending, which is Social Security, Medicare, Medicaid, prescription drug benefits, military benefits, and interest on the debt. That has to be paid. No matter what, that gets paid. And that absorbs all the tax revenue. So everything else you want to spend has to come out of new debt. So that's not a good way to create a better economic prosperity in the economy. We've talked about this before. This is why there's a big gap between household wealth, between the top 10% and everybody else. They own all the assets, you don't. If you own assets, congratulations, you're in the top 10% of the economy. Awesome. Now, let's go back to AI. Morgan Stanley's headlines. Oh my gosh, we're going to have to issue $1 trillion worth of corporate debt to fund AI. Maybe. These companies also make a crap load of money. So they might be able to fund a lot of this just out of cash flows. But so what? They issue debt. Debt that is issued that has a productive potential is fine. I can issue all the debt I want as long as it produces something, because whatever it produces will pay off the debt. And that's productive leverage. Let me ask you a question. You see nothing wrong with if I was going to go out and borrow $1 trillion, you say, oh my gosh, that's a lot of money. Okay, I'm going to borrow $1 trillion. What am I going to do with it? I'm going to invest that into something that's going to generate a 15% year rate of return over a 10-year period. I'm going to borrow $1 trillion for 10 years. I'm going to invest that into something generating a 15% rate of return over a 10-year period. Is there anything wrong with that? No. I'm going to wind up with a whole lot of money at the end of the story and pay off the debt, right? This was the brilliance of back in the early part of our last century when we were building the Hoover Dam, the Tennessee River Valley Authority. We used government debt to do that, but those assets paid for themselves multiple times over. And this is the one thing I think the government should be doing, is issue some debt, but issue debt in partnership with utility companies, with infrastructure companies, with technology companies to build out the infrastructure for artificial intelligence, to improve the power grid. Again, because if I'm going to build data factories, what else do I have to build around that? I've got to build roads and bridges to get to those factories. I've got to build the electrical infrastructure to power those factories. We've got more and more people that are requiring, how many households do you know that have multiple computers, household devices, et cetera? They're all requiring some type of power, right? We need to upgrade our power grid. That's a huge, massive expenditure of capital, trillions of dollars to do that. But when you spend $1 trillion in economic infrastructure, that generates about $3 of return, economically speaking, for every dollar you invest. That's a good byproduct. That creates a stronger economic environment, pays down the debt, gets you to where you want to go. See, just funding more and more Social Security, more social welfare programs, increasing more benefits to individuals, that's great. That certainly gets you votes. But that's a poor use of capital. Buybacks are a very poor use of capital. We should restrict buybacks and force companies to invest capital into R&D, development, research, payrolls. That increases economic activity, creates more tax revenue for the economy. But we have this environment right now where most of our spending in terms of debt is social welfare rather than good, productive development. And so I've got a couple articles coming out to talk more about this over the next couple of weeks. They'll be on the website. But issuing $1 trillion for AI expenditures and AI data build out, that's not a bad thing for companies. And yeah, if it costs them $1 trillion, they're going to make $2 trillion on it, give or take. Good for them. But that's an idea that we should be adopting in our political realm. Instead of fighting with each other all the time on everything, saying, look, let's come together. Because again, the last time that we had an environment to where we were focused on building a future was in the 50s and 60s with the space race. And that's when you had state fairs coming out, and you would go to state fairs and they would have all this future technology out there of what could be because of the stuff we were developing. And the stuff you have today, from cell phones to microwaves to refrigerators, all came out of the space race. That was a massive leap forward for America at that point in time. And we need to replicate that. And we have that capability right now. We have that opportunity to harness the power of ingenuity and engineering and capital and to put it to work and build a much brighter economic future for America in general. And I'm not talking about just the top 10% of income earners. I'm talking about a better economic prosperity across the United States. We have that opportunity. I just hope we don't squander it. All right, wraps up the show for the day. Be back tomorrow with John Penn. We'll have Two Dads on Money. Got some good topics for younger investors tomorrow that we'll be getting into here on the show. So make sure you tune in there, particularly if you have kids. It'll be a great show for them tomorrow as well. All right, have a great day. Get by the website. Be sure and like and subscribe to the channel. Again, starting August the 4th, we'll be live, digital only, X, TikTok, YouTube. More channels coming your way. We'll eventually be on Facebook as well. Meta, whatever you want to call it. It's there. Anyway, we'll be there live. But make sure you're subscribed here on YouTube. You'll find about it there first.